My name's Dave DeBow, founder of MoneyPartnerFormula.com, and this show is built for everyday real estate investors who are actively doing deals and looking to scale using other people's money. So if you're an active real estate investor and you want to get featured on this show to talk about your own real estate and capital raising experiences, then just go to daveinterviewsyou.com. Now let's get rolling with this episode, and remember to subscribe for daily interview content.
All right, guys, welcome back to Property Profits Podcast. I'm your host, Bryce Kaminsky, filling in for Dave Dubois. And have you ever wondered what it takes to thrive in the ever-changing landscape of real estate investing? Well, today, my guest, Tony Ning, a seasoned real estate investor with over 4 decades of experience, is here to unravel the mysteries behind navigating the highs and lows of this dynamic industry. Tony, welcome to the show, man. Great to have you here.
It's a real honor, Bryce. Thank you for having me.
So, 4 decades. You've been in the business as long as I've been alive, so we're going to dive into that. But tell us what it's like to get started in real estate at age 18. You know, a lot of people are just trying to buy their first car, get their first prom date, and here you are jumping into real estate at 18. So what was that like?
Well, I tell you, it was out of need and necessity. When I was 10 years old, my parents got divorced. My mother was a single mother, I should say. And she was struggling. We were facing eviction. We were getting eviction notice from time to time, and she was totally depressed. And one day she sat down with me and said, "You know, Tony, all I want is to own a home so I don't get evicted by any landlords out there." And I tried to figure out, how can I help her? I'm helpless. I'm just a kid. No, but serendipitously, I ran into a book called Think and Grow Rich, and it really changed my mindset, right? And by doing so, I was able to go to work at 15 years old. I was washing dishes for restaurants and doing waitering jobs where I got a lot of tips. So I was able to, in about 3 years of going to school and working part-time during the summer months and also during the weekends, I was able to save up half the down payment, and my mother was able to do the same thing as well. So anyways, combined, we put our money together and we went to purchase a home. This was a home that was privately for sale, wasn't listed by any agents, privately for sale. And we went to approach them, and we struck an agreement. And but the problem was I was still going to school at 18 years old, and I went to the bank, CIBC, I still remember, and great manager there said, "Tony, you know what? I could get you the loan, but you have to quit your school and be full-time at your job because you don't make enough money part-time."
Yeah.
So that was a terrible blow. I thought, hey, you know, we get the down payment. We should be able to just buy a home, right? So anyways, long story short, went back to the sellers and, you know, all distressed and said, "Listen, is there any way we could structure a deal together? The bank won't lend us the money. I mean, if you guys are selling, can you take our down payment and hold the mortgage?" I didn't know what the terminology was, but now I know it's called vendor takeback or seller takeback mortgage, right?
Yeah.
And they huddled a little bit. I said, "Listen, I'll give you full price. I won't negotiate the price. And on top of it, whatever rates that they're offering you, if you took your money and put it in the bank, I'll almost double it, right?" So I 11%. 11% at that time I think it was running around 6 or 7% at the banks. "I'll give you 11%. Just hold the mortgage. Let us get into the home that we want."
Mm-hmm.
And lo and behold, they agreed, and that's how I got into my first home. So after a few years' time, I saw the price. Let me to backtrack a little bit. The way we could afford the home was my mom was always saying, "Listen, we can't afford the mortgage payments, the property taxes, the utilities. We can't afford that, right?" I was just 18 years old. So anyways, we came up with the idea where we just house hacked. Right? We rent everything out, every room, every space of the house up, except for the part that my mom needed for our own purpose. So anyways, long story short, we were able to house hack, get rental income from it to help us pay for the mortgage and all the expenses. And we were successful. And after so many years, it was paid off, and it was worth a lot of money after that. But the price of the homes had gone up substantially over the next 3 or 4 years since we owned it. And that's when I said, you know what? This is probably a good way to invest my money and to maybe make a profit investing. So that's what I did, and getting into music was great. I took some courses, some of these gurus that were on the TV doing info commercials. I went to the seminars, learned a few things, and they said, "Hey, it's easy. Just buy property for 30% below the market value, right?" And
Yeah,
it's
if you can find it, right?
easy to do, right? But that was a course that I paid $500 to learn that. So, anyways, long story short, I was writing offers, and they said you can write offers with $1 deposit, right? Because
Mhm.
anyways, I wrote about 4 or 5 offers like that, and the sellers took it to the lawyer, and the lawyer said, "Don't deal with this guy. This guy's, he's trying to pull a fast one on you." Long story short, that's when I figured out two things. Number one, I have no access to the data.
Mhm.
Even know that property is worth what they're selling for. I have no idea, right? Uh,
Right.
so I had no access to properties that were listed unless I went through an agent. So that's when I decided I have to get my real estate license just to access the MLS system and also to be able to do my own comparable market research, right? So that was,
Yeah.
and after that, things just grew from there. I just, I started getting a lot of friends and family saying, "Tony, help us buy properties and do flips or buy and hold and that type of thing." And that's how it all began. So 4 years later, I've done a lot. I don't want to announce how many deals I've done or how much money I've made. I think that's irrelevant. I think my experience and knowledge speaks for itself. But I find a lot of people out there that are teaching courses that are bragging about, "Oh, I did so many deals, I made so much money," right? And all they're really doing is just trying to sell a course. And I don't want to do that. I don't want to be pretentious that way. So I'd rather just let my knowledge, my experience, speak on my behalf.
So let's talk about that a little bit. What are some key lessons that you learned through nearly 40 years of real estate investing?
Well, you know what? I'm writing a book on it, and I coined the phrase places, PLACES, right? And I'm going to be quick about it because it's a pretty intensive course, a book, I should say. And the P stands for property, right? Property, it's real. You can touch it, you could fix it, you can improve it, you can tear it down, build new, you can live in it, you can rent it out, you can sell it, of course. But all these things are hard to do with a stock, right? You could buy an Apple stock, that's it. You watch the prices go up, go down, go sideways, right? And then paper is ownership. You're a registered owner, right? So you're not subjected to corporation manipulating the stocks up and down. You own this property; it's yours, right? You can will it. The price. Okay, what kind of price are you going to be purchasing this property for? And as well I do, and all the audience out there that's watching us right now, the profits in the buy. So you have to buy right. Okay, that's important. And then population, right? Is it growing? Is it declining? How do you know, right? Some of the triggers that I learned over the years is wherever the GO train goes, right? If you're talking about the Greater Toronto area, you're looking at Barrie, Hamilton, right? Wherever the GO train goes, that area is going to grow. You know why? Because the government did a lot of research into these areas that population growth, right? And they're not going to put a GO station in somewhere where there's only a few hundred people living there. So that's important. Okay. Power team. You need a power team, right? If you don't have your lawyers, your mortgage brokers, your home inspectors, appraisers, contractors, property managers, and even realtors in your power team, you're gonna lack a lot of knowledge and help in that regard, right? Okay, so getting to L, I hope I'm not taking too long, but L is for leverage, right? Leverage, I've bought a lot of properties using a credit card back in the day. It's a little harder now because now your credit and everything else is online, so they can check it very quickly. And also they're looking for verification that you pay your taxes and type of thing. So it's a little bit more difficult now, but back in the day, I used to, you walked in the bank, and at that time they were offering 5% down payment to investors, right?
Mhm.
So you buy a credit card, and I've done a lot of 100% financing. I even got leveraged it to the point where I get money back on closing without putting money down, right? And how do you do that, right? You just time it so that when you buy a property with tenants in it, you absorb the first and last month's rent, right? If you time it properly, you're going to get first and last month's rent, and that could pay for your closing fees, your land transfer tax, and all that stuff. So, but anyways, it's a little bit more advanced for most people. And the other way of doing 100% financing, I've done this quite a bit, is to joint venture. Joint venture, syndicate, whatever you want to call it, partnerships, whatever. That's a great way of doing 100% financing. Why? Because there's people with money, they don't want to learn this stuff. They don't know how to do this. And they don't want to buy a property that's a loser, right? So if they team up with somebody that knows what they're doing, they're benefiting, and also the person that's putting it together is benefiting, right? So that's leveraging appreciation, right? A is for appreciation. You have capital appreciation, where of course the value of your property goes up over time. You have forced appreciation. You go and buy it, fix it up, it's worth more, right? If you do it right. And then you also, like such right now, the additions like laneway housing is popular right now, right? And the one that most investors overlook is the rental appreciation, because rents go up in time. So even if you bought a property right now, which is breaking even, 5 years from now, you probably have a positive cash flow. Okay.
Yeah, it's the property goes this way and the rents go this way, that gap starts to build, right?
Exactly. And then my C is for cash flow. Depending on your strategy, sometimes, most of the time, if you're holding for long term, you want a positive cash flow, right? The way I analyze that is that if you have, say, $500 negative cash flow on property, and you bought 10 properties, that's $5,000 negative, right? At what time, at what negative cash flow will you stop? Minus 10,000 a month, minus 20,000, but at some point you have to stop, right? But if you bought properties with positive cash flow, let's say 500, and then you bought 10, now you get 5,000 positive. Do you need to? You can just keep building, right? That's one of the strategies I learned over the years. So positive cash flow is very important, in my opinion, for long-term holds. Negative is okay if you're going to flip it, right? You're going to have negative cash flow when you flip it, because you're doing some renovations. It might take you 6 months to do the renovation and put it on the market and sell it for a profit. So negative cash flow is okay. So depending on your situation, that is important, right? And of course, C also stands for control, right? You own this property. It's on land registry and land titles. You own this property, right?
Yeah.
You could buy stock, and sometimes, especially Bitcoins, you get scammed out of your money, because your money is sitting somewhere digitally, and whoever is controlling that money is, they could take off your money and go somewhere, and you'll never see it again. But anyways, that's my opinion. But with real estate, it's harder for anybody to scam you out of your real estate property.
Yeah, definitely.
And then another thing to see is changes, right? You have to watch for changes, interest rate changes, population changes. If they put a new hospital in, put a new Costco in, they put a new Walmart in, those are important. Highway access, right? GO train stations, things like that will make a difference in terms of the area appreciating or depreciating. So you have to watch out for that as well. So I'm almost done. I got just three more to cover, and that is the E. E is for equity build and exit strategy, right? So equity build is when you have capital appreciation, forced appreciation when you fix it up, and also your mortgage pay down. Okay, combined builds your equity over time, right? And the exit strategy, you better know what you're doing. Okay, you better know what your exit strategy is before you get into it, right? So let's say you want to flip it, doesn't work out because the market went against you, or you paid too much for the renovations, or whatever it is. Okay, what are you going to do now, right? You better have a plan B, and the plan B should be a longer term hold, right? So that exit strategy is important. And the final one is S, which is sheltering from taxes. You could write off the expenses, because it's a business. Real estate is not just investment. Real estate is an investment and a business, right? That's why you can write off expenses, right? And then there's capital gains exemption. I don't know what's happening to that right now. It used to be 50-50. When I was younger, it was 100% exempt. And then it changed it to 50-50 when Brian Mulroney became prime minister. And now I think they're looking at upping it to 60% against you. So I'm not sure how that's going to work. And then of course, to if you want the super advanced strategy, is that don't sell it, right? Finance it, because refinancing is not a gain, right? So when you refinance it, you take the money out and buy another property, you're delaying the tax implications, right? And real estate investing, for a lot of people that have said, it's not passive. It's not passive because it's got a business component to it. You can make it more passive by hiring a property manager and or partnering up with someone that's going to do all the legwork, but it's not passive if you do it by yourself, right?
Yeah.
Well, that's my places. I got a few more things to talk about, but go ahead.
Well, you in there, you kind of mentioned, partnerships and acquisitions. you mentioned there's the challenge of balancing acquisitions and building those partnerships. So can you elaborate on maybe some strategies you've developed to overcome this hurdle of property acquisitions as well as building those partnerships at the same time?
Sure. Well, property acquisition, if you're going to partner, you need to partner with people in the know, such as Property Profits, any members here that know what they're doing. You need to know what you're getting into, whether it's a single family home, duplex, triplex, fourplex, multifamily, whatever it is, you sort of have to know that, that particular strategy. And then if you're someone with a lot of money and you just want to make a good return on your investment, right? So you want to partner up with somebody. So the difficulty is for me anyways, is to have investors have the confidence to work with me, right? So that's why I try to educate them as to what I do and how I do it. And any other investors or investment opportunities out there, just get to know the people that are running it, because they are your active partners, right? And if you want to be partner, you have to find an active partner. And for me, it's been challenging for me to find passive partners, although I do have some. I have one that a passive partner that I've had for over 20 years now, and I've got a few other ones that we did some flips on. But yeah, it's been a challenge because I'm not in that circle as much as you guys are, right?
Mm-hmm. So how do you stay ahead of the curve with, over 40 years, the market has shifted this way and that way. Interest rates have come up and they've come down. How do you stay ahead of the curve when sticking in the market for so long?
Well, when you look at real estate, it doesn't go straight up and down. Okay. Stocks, it goes up and down, but over a long run, let's say 20 years, 30 years, it's gone up substantially over the years. I can tell you one of my investment properties, probably giving away my age a little bit, but one of my first investment properties was down in Toronto, in Leslieville, and I paid $63,000 for it, right? That same property is worth over $1 million right now, easily.
Yeah.
So over long term, it's gonna appreciate over time. So I would say, depending what you want to do, if you're buying and flipping, you're really an active player, right? Because after you flip the one property, you have to find another property. So it's more of a business than an investment when you're flipping properties. When you buy long-term hold, that's more of an investment strategy alongside with a business strategy. The business strategy is to be able to write off the expenses and also to be able to capitalize on the appreciation over a longer period of time. So those are the things that you have to look at. I mean, I have people that they just want to flip. They want to make some current money right now, and that
50K, 100K or something. They want to make some money.
There's nothing wrong with that, but that's really just a business, a short-term business. Because when you can't flip because of whatever, you can't find the properties, find the good values to buy, then you're kind of stuck in that realm. So I think, for me anyways, the perfect strategy is to make some long-term buys and some short-term buys. Flip a few of them and buy one for long-term. Flip a few more, buy one for long-term. Instead of flipping two properties, making a bunch of money and going to Vegas and gambling at it on the casino.
Trying to put it all on red. So one of the things I think that's keeping people out of the market today is especially the affordability in the GTA.
Right.
There's places you can buy property, London and Barrie and Hamilton and stuff, where it's more affordable, but the interest rate is still scaring people off the table. What would you say to an investor who's like, I want to start investing in property, but I'm worried about negative cash flow or break-even cash flow, especially when I'm starting?
Well, what I say is, regardless of what the interest rates were, I mean, I've lived in the period of time when the interest rates, is before you were born, I think, was 21%. Okay, and people were investing back in those days, right? So it's just adjusting. The bottom line is not the interest rates you pay, right? The bottom line is your cash flow. That's what you got to focus on. Can you get enough rental income to have a break-even cash flow or a positive cash flow, or just a slightly negative cash flow that you can handle, right? So that to me is the more important factor number if you're looking for a long-term hold. If you're looking for a short-term, it really doesn't matter too much because you're going to flip it and you're going to be out of it. And then the other thing that people never think about, okay, is that there are still some mortgages out there that are assumable.
Mm-hmm.
Find a motivated seller and they have assumable mortgage. Let's say they got a really low mortgage, I don't know, 2.5%, and it expires in 2027. That might be a good opportunity for you, right? So if you could assume that mortgage and hold on to 2027, and there's a lot of predictions that the rates are going to come down in 2024, later 2024 and 2025, etc. Nobody knows for sure, but I don't think the government can keep the rates at where they are for too much longer, in my opinion.
Yeah, you see one article come out, it's Feds expect to cut, and then yesterday I'm seeing mortgage interest on the rise again. So it's like you can't really believe what the media is saying. At the end of the day, it comes down to like who's actually making those decisions. So, um, you know, with all of the things you've invested in over time, what would be a particularly, memorable success story that you could share with us?
Memorable success story. I have to go back to buy my first home with my mom. That
Yeah.
nothing could outshadow that experience because I was 18 years old. I was a young kid, and to be able to accomplish that was like climbing Mount Everest and putting a flag on top of it. So I can't. There's no investments that I can say that can beat that feeling. To be honest.
Yeah. Well, I really like the part where you had to go in and put together essentially like a lease option or a rent to own deal, like a vendor take back with these people. And you're just like, you don't know what it is, but you're just like, could you maybe do it? It makes sense to me in my head. And they're like, okay. And you figured it out and got through it. So,
I know I have
um,
no idea what that was, but I did talk to the lawyer that we're dealing with at that time, and he said, "Yeah, we do it all the time. It's called vendor take
vendor
back."
take back. Yeah.
Yeah, I said,
Yeah,
"Wow."
flip. It's interesting. You're like flipping as a business. It's not an investment. It's to put them together and like season your wealth by like taking one every once in a while, throwing it in the back burner and just letting it cook and then making that short money. Now, when you look at everything you've done in real estate, what do you say your unfair advantages? What comes easy to you that other people might find difficult to do?
My unfair advantage would be that I studied a lot about real estate, not only from the point of view as an investor, but also as a real estate broker agent as well. So I study real estate a lot. And also, I'm very creative. I listen to like a lot of real estate agents don't know anything about investing in real estate and they don't want to
Yeah.
learn. Whereas with me, I'm very creative. I learned, I mean, at 18 years old, getting a vendor take back was very creative for me. So from that point on, I said, there's got to be more than one way to slice the ham or slice the bread, whatever they're saying. There's more than one way, and I look for all the different ways. Like solving a Rubik's cube, which I can do. Right? There's so many ways of solving a Rubik's cube. I just want to explore all the different ways of doing it. And
Mhm.
who has the will find a way.
So you do some consulting for people with that framework that you were talking about earlier, the places framework.
Absolutely.
Um, what does that look like? What are people's experience of it? How long you been doing it for?
Sure. Well, I've been doing real estate for over 40 years, but just to give you an idea, for consultation, I need to know what your appetite is, what you want to do. Do you want to make quick money? You want to make long-term wealth? Like, Warren Buffett said that get rich slow, don't try to get rich quick, right? So
Mhm.
that's buying and holding for long term, right? So I go through all the different strategies. There's the BRRRR, BRR, 5 R's, right? There's buy, rent,
Mhm.
rent, rinse, and repeat, right? So if you want to get into that type of strategy, we can help you. You can flip. You can buy, fix, and flip, right? That's what a lot of people do. But if you buy, fix, and flip, you should flip in a good neighborhood, right? Don't try and flip in a really crime infested neighborhood because it's hard. And also, you want to flip in a high demand. And in my opinion, you should flip to an end user because they're the ones that are going to pay over asking price. The
Yeah.
investor are looking at the money more, whereas the end users are looking at the condition of the property more, right? And the location and the neighborhood. And then it's rent to own. You want to get into rent to own. Why rent to own? Because less tenant headaches. You can lock in your profits in advance, and you can help the tenants purchase a property based on helping them with credit repairs, helping them with more down payment assistance and that type of thing. So if you're into that, that's great. Also, the one that people overlook is buying pre-construction, right? Because pre-construction allows you to spread your deposit over long term, so there's less money up front, and you have delayed expenses, right? Until it closes, you don't have mortgage payments, you don't have property taxes, you don't have condo fees, you don't have utilities, you don't have property insurance, all that stuff that will start right away if you bought resale. But pre-construction, if it closes in 2027, 2028, you don't have any of those expenses up front. And then you can also flip pre-construction. It's called assignment, right? You can, before the closing, you can assign that to another buyer for a profit, right? And there's no need for renovation. If you buy resale, a lot of times you have to redo the kitchen, redo the bath. There's renovation costs, and that money coming out of your own pocket, right? Because construction's brand new. You don't have any renovation costs. Once you get it, it's all renovated. It's perfect, right? And the long closing allows more time for capital and rental appreciation as well. So that's another strategy, right? And the buy and hold, I think a lot of people know what buy and hold means, but the advantage of buying and holding is allowing more time for appreciation, capital appreciation, and rental appreciation, and cash flow. I mean, I know people that are living off the positive cash flows, right? If you bring in 5,000, 10,000 a month positive cash flow, right, and you hire a property manager to look after it, I think a lot of people could live fairly decently, or give you a lot more time freedom if you had $10,000 coming in every month passively.
Yeah.
And
especially if you live not in Toronto. If you live somewhere a little further out of the GTA, that might go a little further, right?
You have the equity built, right? You have your principals pay down or principal recapture. You have that, and then you can shelter from capital gains taxes because it's considered an investment property. When you sell it, you some of that capital gains is sheltered. You can also refinance it instead of selling and take out the money and have a good time. And guess what? The tenants are paying for your mortgage payment, increased mortgage. And then multifamily. Some people want to get into multifamily. There's more income from one location. It's a little bit easier to manage because instead of having 20 properties spread out all over the place, you have one property that's got 20 units. Financing based on properties of that nature is more based on cash flow, or what we call cap rate, or return on investment. Returns. So it's a different type of qualifying for the financing. And then of course, joint venture. If you're not seasoned at this, joint venture with somebody, syndicate, do partnerships, learn from them until you understand how it is to win. Because in a good market, everyone's a genius, right? But in the market, you
gotta work for it. Yeah, you gotta work for it.
And everything that you don't understand and you don't know, it comes shining through, right? It's best to know. I've been through probably 3 or 4 down markets already, and high interest rates and all that. So it is a matter of understanding what the market's doing and navigating around it. This is actually a good time to buy, because this is more or less a buyer's market right now. But once the interest rates come down a little bit, there's so much pent up buyers out there. It's going to shoot the prices up quite a bit.
Yeah, we're like in a little bit of a plateau on the way to the next position, I think. So go ahead.
So Bryce, you can't time the market, just like stocks and everything else. You can't time the market. If you think you're going to buy at the very bottom and sell at the very top, you're fooling yourself, right? This is not what it is. You have to get in when the opportunity is there, and waiting is always a losing game, in my opinion. It's like planting a tree. When's the best time to do it? 20 years ago or today. Planting a tree tomorrow, it to me, it doesn't make any sense. So if you have an opportunity in front of you, regardless of what the market is, you get in and you figure out what you need to do to make it work.
Yeah, definitely. So, you got a lot of experience. I think the best thing is if people, reach out to you. So if they want to connect with you, they want to find out more, what should they do? How do they find you, Tony?
My website, www.tonyning.com. They could Google my name. I'm all over Google as well. And I'd be more than happy to help anyone that wants a little bit of insight or a little bit of help. No problem.
Awesome.
Yeah.
Awesome. Well, I really appreciate you stopping by. And until next time, guys, we'll catch you on the next episode.
Thank you, Bryce. Thank you for having me.
No problem.
Hey there, I really hope you enjoyed that episode. And as always, if you want to listen to more daily interview content, make sure you subscribe. And if you're an active real estate investor and you're doing deals and you'd like to get featured on this show, then just head over to daveinterviewyou.com. Now at moneypartnerformula.com, we help real estate investors to create a process for predictably getting capital so they can do more deals without relying on hard money lenders or the banks. We do this by building them a private capital marketing system. Now, if you want help turning yourself into a big money capital attraction machine, then book a call with our team to see how we can help. Just visit moneypartnerformula.com to find out more. All right, take care, and we'll see you on the next interview.